UK inflation came in at 2.8% in May, unchanged from April, holding at a 13-month low. When Iran closed the Strait of Hormuz in early March, traders were pricing 3 to 4 Bank of England rate hikes before year-end, a full reversal from 2 cuts that had been expected weeks earlier. The bottleneck is not whether the BOE hikes today. It is whether the May CPI miss is the beginning of sustained relief or a one-month pause before a harder resurgence in July. Gilts climbed on the data. The 2-year yield, which had reached 4.7% when Iran war fears peaked, implying nearly 4 hikes above the current 3.75% base rate, began to pull back as traders read the study print as confirmation that the energy shock had passed. The logic is straightforward. No spike, no hikes. Buy gilts. But the oil channel tells a different story. Brent crude peaked above $115 per barrel in the 5 weeks after the Hormuz closure. Motor fuel prices in May were already up 25% year-on-year, the ONS confirmed. The fact that headline CPI held at 2.8% despite a 25% petrol shock is not a sign that UK consumers absorbed the energy cost comfortably. It reflects food price disinflation masking the fuel spike, a one-off offset, not a structural retreat. Aberdeen's Matthew Amos put the gilt market's move in context directly. "We don't think Bank of England communication was as hawkish as the market move suggests. Governor Bailey did not sound like a man who was going to raise rates 3 times by September. The market priced the extreme and is now partially unwinding it. That unwinding does not mean the BOE is cutting, it means the panic trade is deflating. The distinction matters enormously for where gilts go next." The buried assumption in the gilt rally is this: that May CPI is a leading indicator of where inflation is heading, not a lagged reading of where oil was 2 months ago. If that assumption holds, gilts are correctly positioned. If the July data breaks it, the rally unwinds.
The detail inside the May CPI release is where the gilt trade's vulnerability sits. Services inflation, the component most closely tied to domestic wage pressure and the one the Bank of England watches most carefully, rose to 3.7% in May from 3.2% in April. Headline held flat, the domestic component accelerated. The relief story and the embedded pressure story are running simultaneously, in opposite directions. On 1st July, the UK domestic energy price cap rises by 13%. That increase is already set. It does not depend on oil prices, the Iran deal, or the Strait of Hormuz. Whatever Brent crude goes between now and then, UK household energy bills go up 13% in 6 weeks. The Bank of England's own March inflation forecast placed the peak at 3.5% by the third quarter. The OECD's interim outlook, released this month, put the UK inflation path at approximately 4% for 2026, the highest in the G7 alongside Italy. This creates the BOE's precise trap. Cutting rates into an environment where inflation is set to rise to 4% from a base of 2.8% is credibility destroying. Hiking rates into 0.7% growth, the OECD's revised UK projection, down from 1.2% before the conflict, amplifies the contraction risk in a labor market already softening before the war began. The gilt rally prices a pause that the BOE can sustain. The July energy data will test whether that pause was wisdom or denial. Susanna Streeter at Wealth Club stated it directly. May's surprise inflation reading will add to hopes that the cost of living pressure cooker is off the boil. The conditional framing in that sentence is the key. The hope depends on the July print not reigniting the flame. The Iran peace deal complicates the picture rather than resolving it. Brent fell to $79.81 as the US-Iran ceasefire framework emerged. If the Strait of Hormuz reopens fully and oil sustains below $80, the July energy cap increase is the only inflation pulse remaining. But the IEA warned this week of a potential global oil supply glut if the peace holds, meaning energy prices could structurally fall just as the cap rise hits. The cap is a lagged administrative price, not a market price. UK consumers will pay more in July even as global oil costs fall. That asymmetry is what the gilt market has not fully priced.
Pound sterling fell on the same CPI data that lifted gilts. GBP USD dropped toward 1.3200, extending a decline from the January 27 high of 1.3869. More than 5% in a single quarter, one of the sharpest sterling reversals since 2022. Bank of America is explicitly targeting further losses to 1.30. UOB described the structure as building downward momentum toward 1.3160. The two moves, gilts up, sterling down, reflect two different interpretations of the same print. Gilt buyers are pricing a BOE hold. Inflation is contained enough for the MPC to stay at 3.75%. Sterling sellers are pricing a stagflation premium. The UK economy faces 0.7% growth and 4% inflation, and a central bank that cannot credibly respond in either direction is not a currency anchor, it is a liability. Quilter Cheviot's Jonathan Raymond named the structural issue. The UK and Europe look more exposed than the US because of their reliance on imported energy, and that is now feeding into expectations of weaker consumer spending, softer growth, and pressure on corporate earnings. These two positions require each other to be wrong. If the BOE holds today and inflation proves genuinely contained through the summer, gilts are correctly positioned and the sterling sell-down is excessive. If July's energy cap drives CPI above 3.5%, the pause trade breaks. Gilt yields reprice higher. The 4.7% peak becomes relevant again, and the gilt buyers who moved in on May's data take the loss. There is one genuine counterfact. The Iran peace deal removes the Hormuz risk premium that built the original inflation scare. If oil sustains below $80, the summer cap rise may be the last inflationary pulse rather than the first of several. That scenario supports the gilt trade, but it depends on a peace agreement that Trump himself described this week as "you never know with deals." The variable that decides this is not the BOE's decision today. A hold is fully expected. The variable is whether Governor Bailey's guidance explicitly acknowledges the July cap as requiring a reassessment of the pause, or whether the MPC signals confidence that the current path holds through the summer. That language, not the rate decision itself, is what the gilt and sterling markets are waiting to price. Gilt holders watch Bailey's forward guidance on the July inflation path. Watchlist buyers of sterling at 1.320 watch whether GBP USD holds above 1.3160 after the BOE statement. A break below that level, per UOB stated momentum signal, indicates the stagflation premium is deepening rather than resolving. The May CPI reading bought the BOE a week. The July energy data decides whether the pause was earned. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.